Hi there, and welcome to this webinar on building a finance function post Series A and beyond. I'm Kevin Cook, and I am one of the co-founders and the CEO of Treasury Spring, a London-based fintech in the cash management space. Absolute pleasure to be joined today by three genuine experts in and around the field of Treasury and FX. So to my immediate left, I've got Alex Chernoff, Executive Director from Global Reach. Alex has been there for, gosh, a long time now, 15 years plus. So I've been from when Global Reach was itself a relatively small company, I guess, through various stages of PE ownership. And over that time has dealt with treasurers, finance directors from early stages all the way through to some big sort of FTSE 25 companies. Then I've got Travolta Mahol, so treasurer at Tide, big VC-backed company that I'm sure a lot of you will have heard of and know about. I see their adverts on my train every time I come to London. Travolta spent a couple of years there, and before that, many years at NatWest Markets working in treasury and derivatives. So again, huge experience. And then all the way to my left, with the most experience in the room, Francois Mascalier. Experience is a good thing, Francois. Francois Mascalier, who is chairman of the European Association of Corporate Treasurers, chairman of the Luxembourg Association of Corporate Treasurers, and also CEO and owner of Simply Treasury, a treasury consultancy firm. Francois spent many years as group treasurer at RTL, big Luxembourg-based company, and so has a huge wealth of experience in building out finance teams and experiencing many of the issues that everybody from startups through scale-ups through the biggest companies have and do continue to experience. So brief introductions, but what I'll do first is maybe just go around the table and ask everybody to give a little bit more of their own background and an idea of how they interact with particularly scale-up companies and how they've seen different companies over their time in their various different roles building VC-backed treasury finance teams and beyond. So, and Alex, do you want to go first?
Yeah, perfect. So thanks for the introduction. As Kevin said, I'm one of the executive directors at Global Reach. So we're a private equity-backed foreign exchange business, primarily providing corporates with non-banking FX solutions. So I work with finance functions within small, medium, and very large businesses to help them as efficiently as possible manage their exposures to foreign exchange, and that can be at cash flow level or at balance sheet level with translational risk. So we really try and help businesses understand exactly what their exposures are, the costs that are involved, the risks and rewards of hedging, the benefits, and then we actually go to market and help them achieve some really competitive pricing as well. So we're helping them reduce costs that are associated with FX exposures and hopefully just remove as much risk and volatility as possible.
Excellent. Tide, as a treasurer, having been there for a year, I've been able to bring my experience from NatWest Markets, where we set up a new treasury function for Brexit. But within the fintech space, there's a lot of within the fintech space there is a real desire to have a strategic view in terms of cash management and cash flow forecasting, and over the last year we've been able to implement new processes as well, and we'll probably get into that once I get comfortable with this out.
Okay, with me, so as you mentioned, different roles. So in my capacity of chair of a corporate treasurer association and former treasurer of multinational companies, not only Intel but also Begancé. So I work more with a large company, but it's interesting because large companies are of course well organized, well structured, so we know to where we should tend. But in my capacity of, let's say, CEO of the advisory company, Simply Treasury, I work with different type of customers. Of course, it could be large companies, and I have some in my portfolio. It could be private equities and real estate company, because Luxembourg, where I'm based, it's the second largest place for these industries, the alternative funds in the world after the US. So it's quite a big place. We have also a lot of family offices, which is also quite interesting animal, because often with huge portfolio and not sophisticated treasury management or finance management. and not automated. So we will talk about that. And also SMEs, because you have this kind of companies having a sufficient size to be exposed to FX or to funding or to whatever problem, but maybe not big enough to justify full-time trader and ad hoc, let's say, IT tools. And I also work with fintechs, so interesting because fintechs are more there to help them in shaping the products for the market. But I realized that they face the same problems. So small size, so treasury could be rapidly an issue. So I also try to help them. And maybe later I will talk about a solution because there are solutions, good news, and there are tools, also good news. So I will explain later. But I work with this kind of industries, and very interesting to compare it to see if we can, let's say, make a parallel and duplicate the solution of large multinational companies and bring them down to smaller entities, startups.
Yeah, I think that's the fascinating thing for us. So over the last 15 years or so, my business partners have been working with different sectors, and we've worked with treasurers from some of the largest hedge funds in the world, many of the largest banks, all the way through to big corporates, such as those that Francois used to work at, and others. And we continue to see mistakes, parallels made across the piece from the very largest companies all the way through to the very smallest, and everybody to some extent is striving for the same thing, which is treasury is multifaceted but relatively tractable. There are only certain things that we're trying to do within finance, within treasury, and in theory, the guys on this call who would be interested in this are interested in how they can build something that scales. You don't want to build something that is only applicable to you when you're a 50-person company, or only applicable to you when you're a 100-person company. The idea is that you can build processes, technologies, teams that operate at scale as you continue to go through to many other companies will want to be the FTSE 100, the FTSE 250 companies of the future. And so trying to understand the learnings that we can get from the bigger corporations, and also that the bigger corporations can take from the smaller corporations who have a blank sheet of paper, who have the benefit of not having legacy systems, legacy IT, legacy structures in there, I think is something that hopefully we'll try and get out today. So, I mean, Travolta, I guess, being at the coalface, but you're the practitioner in the room, like maybe talk us through when you first came into Tide, what did the finance function look like? How did you fit into the finance function? And maybe coming out of a big bank, coming out of a big team, how did you feel about what was set in front of you in those first few weeks? Because I'm sure a bunch of people who watch this will be in those sorts of positions, having either just raised money. I think you came in just after Tide had raised a big check, and trying to understand how they go and build things.
Yeah, it's quite a daunting experience, as well as joining during the whole lockdown phase, not meeting the team and not being able to just get basic access to systems and things in a very straightforward manner. But joining the team, there was a established finance function, with a CFO and a VP of finance who were already doing very thorough liquidity stress testing and doing forecasting. And I came in as really with the purpose of looking at opportunities. If we raise more cash, what can we do with them? What can we do with this cash in our acquisitions and things that we can build and support further products, and also around the threats as well. Who's really segregating the responsibility of who makes the payments. How do we have the control first line and then second line of governance and then audit as well. So as you grow and scale, looking at opportunities and threats and breaking them down rather than just managing balances is a good way to go about it. And then also aligning processes. So often as we grow a company, we often really focus on revenue and servicing the customer and building products. And often all the data that we have can be around that side of business. But internally, just understanding, could we also, as a fintech, have the same level of clarity around our own balances and connecting it through different APIs and reporting. That's been a real focus, and it's a long project as well. So providing that level of granularity to our internal stakeholders as well.
Yeah, I mean, I guess for anybody who's VC backed, runway is absolutely critical. We've certainly all been through it, I'm sure, where you go through fundraising cycles, you raise a whole bunch of money, you then have to work out how you're going to spend that money, what point you need to raise again, how much you need to raise again, the cost benefit dilution, all of those sorts of things. You know, any from your perspective in terms of getting a handle on runway, getting a handle on cash forecasting, you know, at Tide, out of that, were those things, you know, it sounds like they were already started, but you know, any tips for people in terms of either tools or ideas, and just how important is it to get on top of those things?
It's very important, and it's something that we look at daily in terms of, if you're growing and you're scaling, then you'll have a high burn rate. And so being able to work with the product controllers who will work with payments and invoices, understanding what are the big ticket items, when do they come through, what dates they fall due, understanding monthly to weekly burn rate as well, and then planning for that. So as you scale, there could be certain drawdowns on liquidity, and you may have to really tap into some reserves. So understanding, you know, how encumbered are those cash balances. So if you have 50 million, say, for example, then 25 of that, or for example, a large part of that could be staggered in certain dates. So just really understanding, you know, for that runway date, what are you going to do before you get there, and what refinancing do we need to stay on top of.
So making sure that you've got an idea of you know, what cash flow dates you've got, and making sure that you've got liquidity available on those dates, and also understanding that sometimes, particularly as we move into a rising rate environment, there's some cost to not putting money out for term, but making sure always that it's available when you need it. So sort of balancing those two things of trying to make sure that you sweat the excess cash, but at the same time, you don't compromise liquidity to the extent that the business knocks on the door and needs to make an acquisition or go build it, and you're not able to fulfill it.
Yeah, exactly. And working with the your providers as well. So working with venture debt funds, it's good to get experience in what items they look for. So often you submit reporting to them, so you can have a two-way conversation. What are the key metrics that they look at as well? So it might be a small function, but you can leverage off that as well.
So making sure that, you know, if for whatever reason you do liquidity, you get the calculations wrong, there's a backstop there, and there are other options and routes to bring finance into the business.
Yeah.
Francois, I'm sure you've seen a bit of cash flow forecasting in your time, and you know, probably quite an evolution of that in terms of, I mean, we still speak to many large corporates today who find cash flow forecasting very difficult. What lessons have you had over the years?
Interesting thing, when you look at the last two, and we will release very soon the last ESCT European survey. Of course, it's large multinational companies, but despite the fact that they are quite sophisticated, cash flow forecasting is still #1 top priorities in the next 12 to 24 months. And for the last 3 years, it could be explained by the COVID situation and now the war in Ukraine, but still it just proves that something that is a classic risk, like FX the same actually, are still on top of our list. So why? The reason is because the visibility is difficult. I can imagine that view visibility is even more difficult. And so it's why, by the way, we have also some policy, internal policies, where we try for accounting reason to keep let's say asset management and placement, deposit or money market funds very short term to qualify as cash equivalent IS7 under IFRS, and to offset the gross debt, but also because the CFOs have very low visibility these days, even in large multinational companies. So I see the parallel, and don't think because it's big and large multinational companies existing for 100 years that they are better equipped. Sometimes are still using Excel spreadsheet for cash flow forecasting. So the difficulty is to find tools, and there are tools, good news, but to integrate the tools with the different ERPs, treasury management system, and to get access to all the data, just to provide, let's say, reliable cash flow forecast, where you can also plug some stress test scenario, because these days, and during the COVID, CFO were completely excited and asked for many questions, what if? And so a lot of traders were producing decent content, but took days to produce the content. And you know, when you need cash flow forecasting, it should be immediate. So it's why they keep asking the trader to keep money very short term, and it's why money market funds are so important. So we have a similar issue and similar problem, despite the size, the team, and the expertise.
But it's getting better, right? You know,
It's
certainly
getting
I would
better.
say over
But
the
the good
last.
news, fintech again. So we have a challenger. So because the TMS are supposed to produce cash flow forecasting, but not really dedicated for that. So it's more treasury forecasting. So when you need to plug information and data coming from different sources, different ERP, different platforms, etc., that's another story. So so we always come back to Excel, and so we are over dependent on Excel. So
Is it still Excel at times?
Parts of it, yeah.
Yeah.
There are parts of it. I think I've looked at certain different packages, and it's really justifying. Often you know where the funds are, and so when you can do a certain level of detail modeling within Excel, but you do realize that as you want to grow and connect into all the different ERPs and get items feeding in and automated, there is a natural progression to that. And being a young company, it's one of the items that you have to sell to management when there's other competing reasons for it. So we're always open to it, and you can definitely see the value of it.
Yeah, I mean, I think certainly what we see across the piece, from the large corporates down to the smaller ones, is that it's a focus, and it is only becoming more of a focus, as you say, post-COVID, post-inflation, post-rate rises, post-supply chain shocks, post-Ukraine war. Like it's something that everybody is quite rightly super focused on, and getting that visibility in the first instance in ideally a single place across multiple accounts. And visibility of forecasting is critical. And obviously, cash flow forecasting plays into FX as well, Alex, to quite a degree, I imagine.
Yeah, absolutely. There's a couple of key topics that you guys have just mentioned that I wanted to pick up on. The first thing is the run rate. Just after you've closed, we've had the pleasure of working with some really successful VC-backed companies over the last few years, and sort of Gibraltar and I were talking about this earlier, actually. But a lot of the time, the UK companies or European businesses that will receive funding in US dollars, or in euros, and a lot of their run rate will be in a currency other than the one that they've received this big lump of cash in. Luckily, you weren't troubled with that, but lots of treasurers or finance functions are. So it's trying to allocate this run rate that you've presented to the board in a mismatch of currency. And that's something that we spend lots of time with finance functions of VC-backed companies to really just explain to them, the risks of not hedging or hedging and the costs that are involved, because, your run rate might be X based on the rate of the day of when you raise the money, but as the exchange rate changes, the run rate changes. And it's a similar story with the cash flow forecast as well. So it's really just trying to understand, as these VC-backed companies grow, a lot of that time that might come internationally. So your cash flow may all be in sterling day one, but these are very fast moving companies with a lot of the time some hyper growth, and the plans for international expansions can come along very quickly, particularly as you get into Series B and Series C, and so your cash flow forecast can change from possibly all being sterling to then being euros and dollars and maybe some currencies further afield. So it's really important to understand cash flow forecast in the different currencies, and then understand the potential volatility and how that can impact the run rate and the funds you've generated. So and sort of as you spoke about, we're dealing with relatively small finance functions. So we're trying to help them as much as we can to understand what those risks are, and more importantly, what they can do to remove that volatility and remove the risks and plan accordingly.
Yeah, I mean, so maybe to stay on FX for a minute or two, I guess, I remember when I first came into finance, and I was staggered by you go on holiday and you have some awareness of what your exchange rate is, and sometimes you go and it feels cheaper, and sometimes you go and it feels more expensive. But then when you actually start working in a genuine finance function, you look at the volatility of even major FX pairs, and you look at the effect that can have on P&L, it can be quite terrifying, right? So we've obviously seen, not sure that you've noticed it unless you were looking at it, but even over the last 2 months in something like cables for sterling dollar, we've seen pretty big volatility, right, in terms of the difference in those numbers. How much has it moved?
Yeah, absolutely. Particularly at the moment, but we've seen swings of 10% on sterling dollar. This year, which is huge. Yeah, if you put yourself in the shoes of a VC-backed company, if you're planning on expanding into a US dollar country that's got 10% more expensive, or if you've just raised US dollars, you've just got 10% more run rate in sterling, for doing nothing. And yeah, these are big moves. And actually, without getting onto too much market commentary, we generally have an opinion that the volatility is going to remain heightened for some time now. We're in an environment where monetary policies are way more active than they have been for a while. We have geopolitical risks globally. So we think FX volatility is going to be heightened. The volatility is real. It will have a major impact on the way you can distribute your cash and your run rate if you aren't monitoring it, or unless you can partner with someone that can help you out, for sure.
Yeah, I mean, even for us, we're a sterling-based company, but because we work in finance and we've got assets effectively on the platform, we report all of those in dollars. And so our sterling and euro dollar equivalents have been dropping over the last recent period of time. So even though there's no difference at all in the business, actually, it doesn't matter to us, because even though we report in dollars, our revenue is based in sterling. But for investors looking at it, suddenly, even from a reporting perspective, if you don't explain that volatility to people, they can look and go, "Oh, why are your assets down 8%, 10%, or whatever it is?" Well, they're not actually. It's just FX.
Yeah.
And people sort of scratch their heads, and I think it's quite poorly understood generally the effect that this stuff can have.
Yeah, you're absolutely right. When you look at the monthly reporting often to the board, if you're holding cash, in your currency that's not your reporting currency, and you have to report every month to your board, this big volatility in the value of the money that you're holding. It's about understanding that there's tools that you can use to remove that volatility entirely if you choose to. But it is just really about having an understanding of what that volatility is, and just being informed so that you can make the right decisions.
Yeah, I mean, Francois, you've obviously worked in multinational companies with flows in many, many different currencies, I'm sure. Probably got some insights and maybe some horror stories to share in terms of what doesn't work in your experience over time, and how important FX management is.
Actually, when you look back, many things to explain, but when you look back, the big game changer for corporate traders was the adoption of IFRS and US GAAP rules. So when PAS 133 and IAS 39 came, and it was in 2005. So in my company, we implemented it in the summer 2000. But when it came, so edge accounting became very important, because in the past we were in the different accounting situations. So volatility was not that important. I mean, interim unrealized volatility. But these days it's important. So it's why corporate traders, we have the culture of mitigating risk, because P&L is important. For startup, maybe you are loss making sometimes. So okay, additional loss, it's not a big deal, it's not a priority. Or like PRE in Luxembourg, so a lot of them. So they make so much money that the FX impact is minor to vis-a-vis the return. But for corporates, any single impact on the P&L could be important. And when you ask to the CFO of a large multinational company, what is your risk appetite, or what is your risk tolerance vis-a-vis FX, they say 0. So then you try to hedge not everything, but to hedge a maximum of things, at least the on-balance sheet exposure, because off-balance sheet is a different story. On balance sheet, you try to have a full match, so you have no surprise. So if you hedge at the right time, so it should have no impact during the lifetime of the hedging and the exposure, because normally the two legs are offset.
I mean, maybe just to I don't know, maybe some people who are watching this, the idea of hedging and how you hedge and what that might mean is, it's maybe something they haven't done or experienced. So I don't know, Francois or Alex, the two of you can give a bit of just a quick explanation to people of how you would think about risk and hedging it.
But just to start an example for corporates. So if you sell somewhere or you import some raw material in US dollar, you are a European-based euro functional currency. So at the end of the day, you will consolidate in euros, so you could be exposed, because if you buy at 110 and now we are at 1004, I guess, maybe less on dollar, I mean, the dollar is stronger, so it could cost more. So it's why for us, the idea is to try to plan when, because timing it's an issue. So it's only the amount you want to offset, but the timing when it could come. And so if you have an outcome in dollar in 6 months, you need to, and you want to plan what will be the cost in euro equivalent of my dollar today. And so it's why we hedge, and hedging means to fix forward the price through forward contract or other OTC derivative, but just to fix the price. And then to make sure that during the lifetime of your hedging instrument, you will, let's say, apply accounting. It's a technical term, but just to make sure that you have no impact in your P&L. And at the end of the day, when you have to pay your dollar to your supplier for raw material, oil, jet fuel, whatever, you will have the euro, and you know the price. So you can, let's say, incorporate your price, your future price into your current P&L to avoid surprises, because as you mentioned, 10% or maybe more this year. It was quite flat for a while, but now we have volatility. And then you have the daily volatility, so we can talk about it. So timing is really the issue, and planning. And again, if you plan 6 months, not 9 months, because if not, you need to roll over. And so it's quite important because we have differential of interest. So it's a bit technical for those.
No,
who
no, but
don't
I think
know.
it's interesting.
So the difference, the price for one is made by the spot rate of today, plus the differential of interest. And today we have a high differential of interest, especially with US and the inflation. And so in euro, we are still short-term very low or zero or negative. So it means that it could have a huge impact on the cost of hedging. There are many other factors we can mention, like Basel III, etc. But still, hedging has a cost, but it's a sort of premium you buy for protecting your business in the future, to fix the price, or to have at least an idea of a certain level of pricing we pay for its options.
The companies you talk to, Alex, is there a sort of a set view across the market, whether it be people raising in one currency and having liabilities in another, or generating P&L in one currency? Is there any difference that you see between those two things, where one you've got a very fixed amount, and another one's slightly more variable?
Yeah, I think it's really interesting, because when you're dealing with corporates, there really aren't many corporates out there at all that don't have some form of FX hedging policy in place. These are mature businesses that have seen, they've seen the FX markets throughout the years, and over time they've decided we need to do something about this. And sort of as Francois said, it can materially impact P&L. But when you're dealing with VC-backed companies, they're high growth. A lot of the time, the FX exposures, might be new, and they might feel not particularly important or not particularly high up the priority list. But our view is quite a simple one, which is that there are many things within a business that are variable and totally out of your control, that you just can't do anything about it. But with FX, you can hedge quite simply. And I think the idea of FX hedging can be quite scary to some people that maybe haven't done it before, or haven't got a lot of internal resource, and there's loads of things going on, and all of a sudden we need to start thinking about FX hedging. But actually, once you understand it, the key is that if you can get hold of your cash flow, and you have confidence over some exposures, you can really quite simply just eliminate the FX risk. And what you're not trying to do is speculate on the market going up or down. You're trying to do the complete opposite, and just eliminate the fact that it is going to go up or down. We don't really care. We just want to know what the rate is that we're going to get. So yeah, most of our clients will have an FX hedging strategy. For VC-backed companies, we're really just trying to work with them to decipher what's the best one for them, because what's right for one corporate is absolutely not right for all corporates. There's no off-the-shelf way to hedge. It's about understanding your business, what's important to your business, what's important to you as a finance and treasury function, and then putting something in place which suits all of that.
Travolta, from a practitioner perspective, I know that Tide's been fortunate to date. You've got largely business denominated in one jurisdiction, but I know that's about to change. And so, how do you think about FX going forward? And also, I guess I know Tide's thinking about moving into places where maybe currency volatility is even greater than you might be between some of the more core currencies. But how does that impact what you think about it?
Yeah, and as some of you may know, that Tide is launching into India in later into this year. So there's been large exercises in moving balances from sterling denominations to INR. And so that's been something that we've done over time anyway, as we've had a workforce in India. But now as we start to launch products there, really it's, as Alex was saying, it's thinking about the cash flow ladder, what structural hedging can we do ahead of time, and also being able to scale that as well. And being a smaller company, we don't have the tools. You may have really good banking relationships, but we're still small relatively and doing very ad hoc business compared to some of their other clients. So we're possibly somewhere in the middle, from not having any exposure to not having enough exposure to lots of daily activity. So with that, we may not get the right level of service. So that's something that we're thinking about, and trying to say, well, possibly in a year's time we might be a lot more active. But right now, just having the odd transaction would be sufficient for us.
Yeah, and that brings an interesting point, and maybe go to Alex first and then Francois, in terms of, okay, fine, I've figured out what my cash flows are, I've figured out that some of them are in a foreign currency, I've decided I want to hedge. Where do I go to do it? Do I just turn up to my bank that I've got my funds in? Do I always go to Global Reach? Obviously, that's clearly the right answer. But how do you think people should think about this in terms of where to go, in terms of FX, but also maybe more broadly for Francois, when you answer it, in terms of how to think about your banking partners and how to understand what is a great thing to build a relationship for, what's a good thing to go to an independent provider for that can give you maybe something more than an ancillary service that it might be that your bank's doing, rather than something that they've got core competence in.
Yeah, absolutely. And the marketplace that Travolta just spoke about is exactly why the independent FX providers, sort of the whole industry was created sort of 35, 40 years ago. Quite simply, there were lots of companies that had FX exposures and they were just underserviced and undervalued by their banks. So sort of the broking industry from an deliverable FX perspective was created to help these businesses sit in between the large banks and these corporates who needed help and guidance from an FX perspective, not only strategically but also to optimize the cost and transactional costs involved in this. So every business is different, and some do rely on their banks, and their banks rely on them for ancillary business. So we have lots of clients that will use us, and they will use some of their banks, and they'll use us for slightly different things. But one of the beauties of being a VC-backed companies is often, it's all quite new. So you haven't got 20 years worth of legacy banking relationships that you have to fulfill. Actually, you can go and find the best service, the best relationship. Obviously I'm going to be biased, but we feel that we fulfill this marketplace particularly well, because what's our USPs? Well, it's high level of service. It's the fact that we don't service tens of thousands of clients globally, so our clients are just more important to us than if you're working at an FX desk at a big bank. So we've got a lot more time for them, which is really important. A lot of the time they look at us as like an outsourced FX arm. So we think that's really important, as long as it isn't as detriment to your banking relationship. So again, it's different for each client, but we have lots of clients who will execute some trades with their bank, and then they'll use us for more of the guidance and the support strategically. As they're growing and developing, they might be moving into new markets, and they want to have a call with us and sort of say, we're looking at moving into India. What does that mean from an FX perspective, and what should we be considering? And
just before I go to Francois, how do I know what's a good price? Because FX is super intransparent generally. You look on a screen, you can see a price, you're given a price that's not the price that's on the screen. If I'm in a finance director in a VC-backed company, I'm looking at the FX. How do I have any idea what good execution looks like?
Yeah, and I think so you've made a good point at the end. Is there's two different things, right? Is the rate that you achieve, and then there's good execution, and they're two totally different things, because the rate changes every second. So what do you know if it's a good rate? No one knows that. Or we'd be sitting on our yachts in the Bahamas or something. But the execution is the thing that you're looking for, and good execution comes from a trusted partner that's happy to be transparent with the spread that they're charging, which is the difference between the price that we get as a broker and the price that you get as a client. So I think it's about having that transparent relationship from the off. Like with any service provider, no one necessarily wants the absolute cheapest out there, because you want to get a good service, you want a good relationship. So it's finding a happy medium where you're going to the counterparty that you're using doesn't look at you as someone who just wants the absolute cheapest all the time, and therefore they're happy to deliver you an excellent service on an ongoing basis. So that transparency with the counterparty that you're using, and don't always search for the cheapest deal, because in the long run, actually, you want to develop a good relationship with the counterparty you can rely on.
Yeah, and Francois, it'd be interesting maybe for you to give the perspective of kind of the journey that the big corporates have gone on in this space, because obviously it's quite different at that sort of top end of the very commoditized FX markets.
The major difference, first, they have a culture of FX, they have the expertise internally, so we know the product, we know the accounting consequences of dealing some product, because accounting is quite important. Sometimes we put the cart in front of the horses, because accounting is also driving the decision we take on financial instruments. Should be the opposite, but okay, accounting should be a translation. But we are well organized, because we have usually policy, and I agree with you, sometimes policy are not written, but at least we normally best practice is to have policies, to know the strategy, to align the policy to the risk appetite of the company. And we use for now 22 years, because I remember I started with FX Sol in the year 2000 after Eurofins conference, where I found it quite interesting. At the time, it was just 14 banks on the platform, but today you have all the banks on all the platforms with different platforms. So platforms are quite good because it can be integrated, and it's a way to benchmark. Was also another problem for you, because for small companies, you have 1 or 2 bank relationship, maybe 3. For large corporate, you have 10, 20 banks. It's important to work with your bank for ancillary business, because you need to give them back some business. So we don't want to tap the whole market, but at least to compare with our partners. And with this platform, I don't want to claim that 360T FXO, you got the best deal, the best execution, but you have a decent execution. And the good news, it's even better than a Bloomberg screen, because the price is the one the bank is ready to deal, because they quote bid and offer, just click, double click, the deal is done. So it's quite, it's really the market price. But a lot of corporates are let's say, focusing on the best execution. When you think about it, they forget the pre-trade part. And it's always important, because for corporates, you have affiliates across the world. So you need to identify the risk, because at the end of the day, your affiliate is exposed to risk because they produce something in India. So you need to hedge dollars. So as a corporate treasury center, you're supposed to hedge as soon as possible. But if you take some time to identify the risk, sometimes you forget that this delta could create a lot of swings, where the best execution is great, but it's not a few pips that makes your life better. And a lot of corporate treasurers, in my view, are too much focusing on the best execution of the deal and the post-trade, and they forget the pre-trade. So the sooner you identify your risk, the sooner you hedge your risks, the better you mitigate your risk. But you're right. So in general, corporates, large international companies are using platforms so they can benchmark and get a decent, let's say, view of the market and make sure the price is good. Because for some corporates or small corporates, what are they doing? They call the bank, and then they try to call another bank to compare. But you have a delta, so you call your account officer, who will call from Luxembourg, the London office, or the Frankfurt office to get a price. So you're losing time, and at the end of the day, they take buffer. So at the end, it's not the best price, but you can benchmark. But old-fashioned, I would say. So that's a big difference. Culture, education, specialist, knowledge of products, and access to the information. But please do not forget that the identification of the underlying risk is more important, because the faster you react, the better.
You get the best execution possible on the wrong trade.
I would say it's ancillary, because it's good, but sometimes they're fighting for a few pips, but they forget that the risk is lying for maybe a week. Yeah. And these days, even today, you have two two figures of movement in euro dollar. So or Canada.
Yeah, and I think for the audience, like maybe the takeaway is, you might all get to a point where executing spot FX over a platform when you've got everything else nailed down is perfect. But for now, you've probably got a little way to go there, which is first making sure that you identify risks, cash flows, hedging strategy, get all of that approved by the finance function and then up to the board, and then find somebody either internally or externally who understands the market, who can help guide you through the processes.
Yeah.
And once you've got all that nailed down, then you can move to nice tech-enabled execution. That takes a little while to get. Maybe moving on to a subject that is naturally close to my own heart, cash investment. So, a lot of the folks who will watch this will have raised material rounds, your average Series A today, much larger than it used to be. Even, Series A's we're seeing done at 15, 20, $30 million. And there are plenty of people raising BEF. How much did you raise, Trevor? About 100 in your?
80 cents.
Yeah. So, people raising really big sums of money, up into the hundreds of millions of pounds, euros, dollars. And a lot of the people who we see raising these sums of money, if I said Treasury policy, Francois could probably write one with his eyes shut right now. But most people wouldn't have any idea what that would mean or what that should look like. So for the audience, maybe let's start with Travolta, because you I guess probably have to think about putting one in place at Tide, and then go to Francois. Like, so when you were thinking about your Treasury policy and how you implement that and what the key factors are, like what were the thought processes?
Yeah. So at a high level, we've got the concept of encumbering time down funds. And really, when we raised the funds, we knew X amount will be for investment in this market, another amount will be for behind supporting other products. But within this cash concept, I really wanted to start investing it and making it generate return, but still being aware that I don't have the luxury of investing it for a year or at a time. And so having been a portfolio liquidity asset buffer manager before in the past, I was well aware of which asset classes I wanted to invest in, but it was a case of I really didn't have the scale. Before you buy 100 million pounds of a single bond, here this could be the whole fund. So really started to work with the risk management team and saying that we should do something with these funds in terms of investing them, but let's get comfortable together in coming up with a risk appetite. Let's get comfortable in terms of the liquidity horizon. So what we did was break down the funds in 3 buckets. So I'm very comfortable investing in these buckets, and these are the reason why. If we were to find a fixed term fund and invest in those funds, then we can size that accordingly in terms of the credit rating of the underlying provider with our liquidity forecasting and when we need the cash as well. So bringing that together with the risk appetite, we were able to take that to the risk committee and get that approved to say we can now utilize this and invest it. So,
Francois, if you talk to any corporate treasurer and ask for this 3-word magic incantation, like they'll tell you it is security, liquidity, yield. Right? Like it's always the 3 words that come out when people are talking about cash.
Usually, again, best practices. Corporate treasurers will first a policy describing what could be done, what could not be done. It's always better because for treasurer, it's good to know the boundary. A lot of corporates, as I mentioned, are driven by the cash and cash equivalent notion in terms of accounting to make sure that it's short-term or considered as short-term, and therefore it could offset the gross debt, because a lot of multinational companies, they are not totally, let's say, short or long. It's a mix of long and short position, resulting in a net position that could be long or short. And you have the long term and the short term, so it's another story. We need also to manage that. But just to explain that for us, it's the first driver. So usually it's a mid driver. So when it comes to that level, so you know at least that if you want to remain within the short term, so it limits the number of products you can use. Depending on the risk appetite, are you ready to take some risk on your principal? But if you receive 100 millions from investors or shareholders, so I guess you should preserve your principal. In these days, we face for a couple of years, some countries for many decades, negative interest rates. So you receive money and you destroy value the day. Time is not creating or generating value, it's destroying value. And so the big issue is to, because it's always relative, so the idea is to preserve as much as possible your cash and to get the best return or to limit the loss, if any. And to make sure that, as you rightly mentioned, you have the liquidity when necessary. So if you have, coming back to the cash flow forecasting, good cash flow forecasting, you can slice your cash and have some buckets or some layers. But that's the theory, because in theory, it's the thing that you can read in books, but corporates usually, and you ask the CFO, say, I would like to have maximum liquidity just to have the agility and the flexibility. So at the end of the day, it results in using money market funds, bank deposit. But then we come to, we mentioned liquidity, we mentioned also counterparty risk, because since the global financial crisis, we understood that bank could also be in default. And so it's a risk, and by concentrating into bank deposit, you concentrate the risk. And if you go for government bonds, maybe you mitigate the risk, but at the expense of the return. So there is no magic recipe. So you put the cursor more on risk, and so you risk with your principal, or you reduce the risk, but you reduce the return. And at the end of the day, are we there to make money on the cash? We are there to protect the money of the company, because the goal of the company is to make money with the underlying activities, your core business. Treasury is just a complement to preserve the cash. So it's why a lot of corporate, but the same for FX, are not making any trading or speculation. They just try to hedge position or to preserve the principal. But for the last 10 years in Europe, it was challenging because of negative interest rates. So
I mean, you can certainly argue with current inflation rates today that in whatever currency or in real terms, you're losing.
So, and the same with currency, because you mentioned when you borrow currency, so in some countries, sometimes it's better to borrow a dollar floating, even if you need a euro fixed. And so you need to have a cross-currency swaps to protect your position. So it's actually tricky. So you need to have visibility, you need to have the expertise, but at the end of the day, you need to know what is my time horizon. And the best thing to do, best practice, is to slice your cash to make sure that you have always, let's say, immediate availability. And it's why the current money market fund reform is quite important for us as corporate treasurers, because a lot of corporate treasurers would like to have same-day value products. So because you don't know your position tomorrow, I was discussing last week with Airbus, sometimes you could have swings of billions or 20 billion in a day. So you need to have immediate access to your cash. So
yeah, and I think it's interesting the difference between some of the large corporates where, as you say, or trading firms where you have this big volatility, and so the idea of terming out at the expense of losing that liquidity doesn't make any sense at all. Puts real business in jeopardy. And but for firms where you have much more predictable cash flows, so you raise a significant chunk of money, roughly what the burn rate looks like. You build in some confidence intervals around that. You stress test it, what have you. And then, as you say, you bucket it, then you can have much more confidence that, okay, even I don't have to pick a particular date, but I can know that I'm going to, in a month's notice or 3 months' notice or whatever, I can always call those funds or get them back. And so, matching liquidity, clearly key. Credit risk, I think, it's amazing the number of people who we speak to who say things like, well, banks will never go bust. A lot of people who only started after 08. And have a perception that it's impossible, that these kind of magical institutions that we call banks will always be around. I guess in terms of Travolta, from your experience working in a big bank and thinking about liquidity from that perspective, and I guess were you RBS through 08?
Yeah, so I joined in 06, so obviously I through it.
So probably quite an interesting place to be, and maybe affected your perception of bank risk going through it. When you start to think about how you mitigate counterparty risk, what are the thought processes there?
Yeah, and I'm very aware of it. The whole Lehman's time and coming in on a Saturday to look at positions, not much more than pieces of paper at that time. Yeah, it's very important at Tide as well. We're very aware of making sure we size our counterparty risk and have the whole framework around that.
And so that'll be looking at the credit rating of your underlying
Exactly.
counterparty, and then say, if you're of a certain credit quality, we'll allocate this amount, and if you're of a better quality, we'll allocate a bigger amount, and if you're of a worse quality, we'll allocate a smaller amount.
Exactly. So I think most people are aware of what there's so much information available, especially if you're publicly rated as well, rated by one of the rating agencies, and we're able to then work with other partners in say financials with and being comfortable around their disclosures. So under the Pillar 3 disclosures, there's a lot of information around their liquidity, the fund position, so we can go through that in another layer of detail and make an assessment as well.
And so I guess implicit in that is diversification as well, in that says you're not going to put all of your money in one single bank,
Or one single fund.
or one single fund, because ultimately, there is some benefit to diversification. Now, you can certainly argue across the banking sector, there's a high degree of correlation in that sector as well, but definitely you're reducing risk by putting it in different buckets. And then you mentioned sort of bonds earlier, like back in your RBS days. Presumably you would have looked at things like government assets and also looked at repo and secured transactions in order to mitigate risk.
Yeah, exactly. So that's a really good way in terms of investing funds and being able to communicate that to wider teams, not just on the desk. So just you can say this is within this sovereign rating. There's different ESG ratings as well now, which are much becoming really popular, and it's a good way to communicate that. So if you're going to buy into a certain government bond, so these are the risks, and you can break down your interest rate risk as well by looking at one specific sovereign and looking at buckets like that. Whereas if you're taking, I think with FX, it's a bit harder than saying I've got surplus cash in one balance, volatility is there, and it's if you're making a decision around investing in another currency, then there's many more factors at play to share that to other stakeholders.
Brilliant. Look, I'm conscious of time, and whilst I can happily talk about this stuff all day, I suspect there are other people who've got better things to be doing. So maybe 5 minutes left. So maybe if we can spend just a little bit of time on what you've learned, each of you, in terms of processes, in terms of what you've seen, either from an FX perspective, Alex, or just more generally from the counterparties that you talk to and the clients that you talk to, and any advice that you've got for people who are watching on how to think about process in the context of finance and the aspects that we talked about.
Yeah, absolutely. So one of our sort of top tips, if you like, is to, as much as possible, try and remove the emotive side of when you buy or sell currency. So we like to try and, again, as much as possible, formulate a strategy, have some guidelines, have a framework in place that says, this is what we believe is the right thing to do, and these are the reasons why. So we go into, from an FX standpoint, this is how we're going to manage our FX volatility. And by having, whether it's board approved or whatever level of seniority needs to go for your business, just having a framework surrounding FX, and I imagine the same is for all other asset classes that a Treasury department needs to look after. Having that framework removes the emotive side of, is the rate good or is the rate bad? And it just, it allows you to go, every 3 months we're going to do this to this degree, and these are the reasons why we believe that's the right thing to do. And yes, that has to be fluid, and you probably have to review it every 6 months or every couple of years, depending on how fast growth your business is or if international expansion changes. But have a framework in place, work with an independent provider to help you put in place a framework which is suitable for your business. Hopefully try and get it signed off by the board. The other benefit of doing that is it means every time you want to do something, you haven't got to go back to the board to ask approval, to have something that's signed off by the board that allows you to work inside that framework. We really think that helps because it removes that emotive side. The FX markets can be very volatile. It can move in your direction or the wrong direction quickly. So they definitely have that framework. We think that's a really sort of top tip for any finance function.
Yeah, I totally agree with that. Certainly we found with a lot of our VC-backed clients, as Francois will know, there's absolutely always a policy in place for the big corporates, but for a lot of the guys who we're working with, they're just doing this for the first time. And so going and making sure that they do get clarity from the board, as you say, ideally, not just for one thing, but for a set of things that operate within a particular framework so that you don't have to continually go back, and that doesn't cause delays to the business. But putting that in place is definitely something that we've seen work and by definition not work where people haven't done it very well. Sure,
I think just picking up on the view and just spending time to get a consistent view that you can share with the board as well. So in terms of our liquidity charts and dashboards, it's a very consistent way that we spend time to arrive there and make sure all the right components are visible very quickly and as needed. I think also for smaller firms, think about within the finance function, you've got product controllers, you've got financial planning analysis, treasury, possibly. Just being able to leverage the data in the same way, I think is quite key. So often we may look at cash in terms of back statement view, and someone else might look at it from a payments view. Really just spending time to communicate how you are viewing the same numbers, really, instead of just a balance sheet view versus a more of a cash forecasting view. You can bring that within in-house, agree, then you can really share the data quite quickly. And I found that's quite helpful, whereas different people are producing their own reports and sending them out to ultimately the same people as well. So that there's a kind of divide and conquer user resource that you have and the team as well. I think there's also around as you communicate the numbers, being able to share and talk in the same terms. So often some people look in quarterly cycles, some people look at monthly cycles, and often just being able to share the numbers on the same terms is quite quick to get consensus.
Yeah, so have a central point of truth. Ideally, make sure that that's able to be used and disseminated to different functions and different people within the group in a consistent way. Francois?
No, first, I totally agree. So it's rather difficult because you don't have the resources, you don't have the culture, the expertise. But the good news, there are some solutions, and personally, I'm working on a solution for PREs and some family offices where we try to have a Treasury-as-a-Service function where you can outsource or even in-source if you need some substance. For PE, that could be important, but you can have access to specialists and so to companies or solutions where you could have experts giving you some specific expertise, FX, funding, whatever. But it's something that I think will emerge. The reason for that is that first, you need a treasury function because you are growing so far that you will need sooner or later a treasury function. Then you need to report to your shareholders. Sometimes your shareholders or private equity shareholders could be highly demanding in terms of reporting, in terms of frequency, more than traditional industrial, let's say, stakeholders or shareholders. So it's important to have access to the right information, to have a good bank connectivity to make sure that you can automate the processes as much as possible. So good news, you start from scratch. You have no IT legacy. The bad news, you don't have any expertise. But the other good news, you have the support of the Treasury as a service solution and the technology. And thanks to the fintech and open banking, PSD2 is opening the market. So we have a lot of solutions that are pure native SaaS solutions where you can implement them and have access to the pro solution, tailor-made solution, but at the price of a solution. So what is great, because the large multinational companies, they rely on the big players, the Kiriba, Ion, FIS, ACP of this world, but there they pay the price of tailor-made solution, and actually it's a solution. So it's the opposite. So the good news for us, we can find a really good solution at a decent price, but it's not known by the market. So we have a big gap. And some of the market players have the impression that we should only serve the heavyweights and we forget the rest. The rest is a big, I mentioned PE, RE, fund services, because Luxembourg is a huge industry and they have many customers, family offices and SMEs, so and startup, of course. So I keep saying that our solution, good news, it's a question of culture, and it should be something that you start building. It will take a while. But if you want to go ultimately to an IPO or maybe to be sold to a third player, you need to have a focus on treasury, because after this COVID period, we know that it was not into COVID, by the way, but the Wirecard story was really damaging in terms of impact. And now we have a huge focus on Treasury. What is good news for us, but in Treasury, but mean that Treasury will be a high degree of focus from regulators, supervisors, stakeholders, investors, shareholders, and so and also auditors. And so it's important to make sure that you start building the function from the beginning. Even if you don't have the resource to do that, there are solutions, external solutions to work like pros within having the pros inside. That's the good news, I guess.
Nice uplifting note to end on. Yeah, to sort of echo that from my perspective. Like, hopefully this has been useful for people. Hopefully it's demonstrated that the finance function within a VC-backed company is certainly multifarious. There's lots and lots of different aspects to it. Not always easy to get your hands around all of them, but hopefully this has provided a little bit of guidance. If any of us can be helpful in following up or providing other insight into what we've seen, what we've learned, or specific products or services, we'd be delighted to talk to people. And otherwise, we leave you to your evening. Thanks very much for joining us.